For me, it's one of those things, Alex, if you keep saying the same thing, you might eventually be right. To me, the seeds for where we are at $66 a barrel came on the back of pumping up above 100 upon Russia's invasion of Ukraine. That tilted the whole world towards the elasticity of supply coming on and demand decreasing. Now we're in the downward trajectory, and we have the stock market going down. We've got a good catalyst for crude oil to do what it normally does for the last 20 years. After it goes above 100, it bottoms around 40. So I made the call almost 2 years ago, and I'm sticking with it. And yes, I used to have hair, but that was a long time ago.
So, Mike, when you see a move like this here, 7.8%, I can't remember seeing percentage moves like that in the past. I'm sure you have here, but what does that tell you here when you see a move like that?
It tells me that what really matters is what's happening in the stock market. We're deflating a massive inflation in risk assets we're way overdue for. But the key thing I noticed last weekend is managed money net positions. Futures started getting too long again, and that's a problem. Remember, futures bottomed last year right around this level when from the first time we had all those speculators or hedge funds getting actually net short for the first time. They bounced back up. We got it back to 80, and they're still long, and it's heading back lower. To me, it's just the whole thing is just tilting lower, and it's not just crude oil, it's copper and silver and most commodities that's just doing what they normally do. They get to their cost of production. So the key thing to remember about crude oil, just last week, Bloomberg New Energy Finance lowered their break-even cost for crude oil in the U.S. to $50 a barrel. You know the rule about commodities, they always go to their break-even cost.
But here's my issue with what's happening in the oil market. And this also goes to tech, which is our next segment. How much of it is actually oil specific related versus the headline stock market tariff? Because I mentioned OPEC adding barrels into the market in the middle of a trade war seems a little bit odd. So how much of this is supply driven?
It was just a matter of time. Oh, it's absolutely supply driven, but the massive supply is coming from the U.S. OPEC's less than a third of global supply now, and the U.S. is the largest supplier. Juxtapose that to when crude oil peaked about 147 in 2008. The U.S. was a net importer of about 10 million barrels a day. Now we're a net exporter with Canada, around 6 million barrels a day. The world has shifted, and OPEC was just a matter of time. We knew that was coming. The fact that they had to hold off barrels was just what's happening, and the fact that China demand is decreasing, and they have to face more tariffs. It's just a perfect storm for normalization. Commodities almost always get cheap after getting too expensive. We're on that trajectory. I don't think we've reached that low price cure yet for most commodities, particularly crude oil.
So, given what we learned yesterday afternoon, and we're not sure how it's all going to shake out in terms of what tariffs will actually be put in place and what time, but I think some people feel like there may be even some wiggle room there. What do you tell your clients these days? Where do you go? What do you do as it relates to commodities? Because I think everybody's just trying to figure out what their global GDP call is going to be.
So my first thing I tell them is expect commodities to get cheap and gold to keep outperforming everything, and read the book by Robert Lighthizer, No Trade is Free. What Mr. Trump explained yesterday was completely laid out in this book. I read it the day after he was elected, and it's happening the way things. The key thing I remember in the trading pits, being in Chicago in the 80s, we used to use this quote that, yeah, everybody in the world wants free trade as long as they can have net export surpluses with the U.S. That's shifting. So the thing for commodities to think about is deflationary forces from the inflation. That's also from another book, The Price of Time by Mr. Chancellor. It's always what happens when you get massive pumps up in inflation. Commodities are heading lower. The key thing is, I think what's going to be the key next trade is we've had a good rally in gold. The next big trade might be U.S. Treasury yields at about 4%, catching up to China at 1.72. This is what happened in Japan. And remember, I traded JGBs in 1995, and I've seen it before.
Oh, okay. Everyone's just bumming me out today. All right, before we let you go, I want to go to ags because ags were pretty much ignored yesterday. There were no exemptions, right? There were exemptions for other commodity products, but not for ags. What is that going to wind up doing to the market?
Well, the good news for ags, it doesn't mean as much for ags. In fact, we might increase exports with negotiation. But we have a glut of ags in this country. We have an excess. We have to export. And the key thing is you look at corn, soybeans, and meat, most notably soybeans, there's massive supply coming out of Brazil. They export almost 100 million tons a year now. That's double what the U.S. exports. And the thing is, we haven't reached that low price cure yet. Our average cost of production for corn in this country, we estimate around $3.70 a bushel. We're still well above that. Unless we have a drought this year, we should head to those lower price levels. This is a normal cycle. You need some kind of surprise to get grain prices and ag prices to go up.